Good afternoon, everyone. Before we begin, I just want to make sure everyone can hear me. If you can hear me, definitely give me a thumbs up. All right, I see some thumbs up. All right, sounds good. Excellent, perfect. All right, so let's get to it. So we got a lot of fun things to discuss today. There's been obviously a lot of things that have happened since the beginning of the year. We could probably go on and on about it, but the main point is we want to make sure we tackle the most important things so that we don't eventually just kind of stay here the rest of the evening, right? So let's try and go through the main things and we'll go through it together. So first things first, a couple disclosures just to be aware of. First things first, anything that we discuss here is strictly educational and does not constitute investment or tax advice. Anything that we discuss here is not enough to make an investment decision off of. So please make sure that you consult with your trusted professional before making any decisions, okay? Again, so just purely educational. And just for everyone's record, this meeting is being recorded by Gemini and our altruist note taker, Hazel, mainly because of the fact so that we will be able to post this onto our YouTube site later for you to peruse at your convenience at a later time. But like I said, anything that we discussed today, specifically with regards to investments and such, if we get into some questions about it in the Q&A portion of it, right, they involve risk. So it's just one of those things, like I said, please view this from an educational lens at all times. All right, so let's get into it. I really wanted to start off with a quote by Peter Lynch, which I think really, really resonates with today's presentation. And I thought, and mainly in this environment, right? Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Long story short, people end up losing more money trying to actually try to time their correction or protect themselves from potential corrections than the actual, just if they would have just put their head in if they would have just essentially not paid attention to the news and just left it alone, right? And the whole point that we're going to get at today is sometimes the headlines can make it that the sky is falling, but when we go and look into the details, it may not be as scary as one thinks. So we'll go through that today. So believe it or not, year to date, as of close of Friday, mainly in response to the news of the eventual ceasefire, which has now been not a ceasefire, but the market still rallied well today. These again are a little bit stale because these are as of Friday, but despite the noise, markets have done okay. We are essentially flat in the US, with international outperforming on the developed side. For those who are not familiar with the terminology, developed is more the Germany, France, Spain, also in certain areas of the Middle East, not Middle East, I'm sorry, in certain areas within the Australia, New Zealand area, some developed countries in the Middle East as well. That's what constitutes developed. Your emerging markets are going to be China, Brazil, South America, certain countries in South Africa, in Africa, like South Africa, etc. But overall, non-US securities have performed significantly better than the US counterparts, and we'll kind of talk about why in the presentation. From the tax-free bonds side of it, pretty lackluster. Same thing on the bond side for both US and international. But despite the volatility, recently, we are kind of holding our own. And will this continue? We will have to wait and see. But what we're going to find out together is that there's a lot of reasons as to why markets have essentially rallied to a more, I guess, maybe not normal market situation, but in a more similar fashion that we've been accustomed to with green across the board, across the different categories. So we'll kind of dig into why. So it's important to kind of talk about as to the context behind the Iran conflict, right? You may have heard in the news cycles that heaven forbid oil goes above a certain dollar amount, we're going to be in trouble. Yes, there is some truth to that, but I wanted to kind of give you the data from the U.S. Bureau of Labor Statistics, as well as just other sources through what we utilize is the Macro Research Board. And a lot of their research we believe very strongly on is because they're not motivated by giving research as to buy my fund because I can navigate this market like Vanguards or the Fidelities and such, and we're not poo-pooing on anything that they're doing. We just don't want that potential conflict of interest. So we go to an independent source. But when we look at the data and we look at historically, when we want to look at what has the prices been for crude oil. So when we look from 1970 till now, right, obviously oil has fluctuated, but what we have seen is that the reliance of oil is not as big a portion of the US economy than one would really think previously. So the top on the chart where it's talking about recent crude oil prices, right now we're hovering, it depends on the day, anywhere around $90 to $100. I didn't check recently today, but it will fluctuate. Where we will maybe see some concern is if we get to that 2008, 2009 level where we see around $200 a barrel, right? And if we see that for a sustained period of time, that's where we may begin to see some weakness in the overall economy. But we're nowhere near that, as you can see. And we're actually, believe it or not, around the average of where oil and gases has been across history, which is also a helpful point to understand is even as oil, let's say, heaven forbid, was to go to that $200 level, really the percentage of crude oil spending as a result of the economic power of the US, it's really only around, we're currently only spending 4% of GDP, right? So it's not really as big of input as we really think it has been in the past, right? So looking back in the 1970s and 1980s, we're talking almost anywhere from 5-6 to almost over 10% versus relative times in history. So overall, what you can take from these both slides is, yes, we're at elevated oil prices, but it's not so much far off from the mean or the average, as we can see on the top graph. And then on the bottom graph, we can see that we are actually relying a lot less on oil today than we did in previous times in the market, which kind of just gives some further support that even with increasing oil prices, we shouldn't see a big impact to our economy, okay? Where we may start to see risk is if we have elevated levels at the $200 price level, right? And which is why, and I'm kind of foreshadowing a little bit, because of these inputs, we're starting to see a rally in the market once things settle down or there's any hint of something settling down with the Iran conflict, okay? And the reason for that is that there's obviously going to be future information that we'll share that investors are banking on that should continue once this is resolved. So some further context with regards to the Iran conflict to put things into perspective, right? To put it into the reliance of crude as versus relative points in time, right? Believe it or not, since 1970, our usage of crude oil has dropped 65%. Okay, so we're just further cementing that these spikes in oil, right, and our reliance on it may be more overblown than what we may be more overblown than what we think. Okay, when we look at it from a aspect of inflation, which we're going on the right hand side, yes, oil is something that we spend on, right? So we utilize the U.S. Energy Goods and Services Personal Consumption Expenditures Index. The reason why we like the PCE, the acronym for that, is that it is one of the Federal Reserve's preferred measures of inflation. So when we look at it as a part of the total input of inflation, it's around 4%. Okay, so it does have an impact on the overall inflation numbers, but what we can see is that it is still a relatively small portion, and it also flows the same way on when it comes to how consumers are spending as a part of their total income when it comes to going and filling up their gas tanks. Okay, so we're not seeing elevated levels of how much an average consumer is spending on energy relative to what they're bringing in from an income perspective or from an inflation aspect of it. So in short, if we're going to summarize from everything we've seen with regards to context, with regards to the Iran conflict and oil, is that a lot of the concerns we believe may be a little bit more overblown or be overblown, specifically just to the fact that we are not as oil intensive as we have been in the past. It's not as big. It's not as big of an item when it comes to our normal average U.S. consumers' percentage of income. Okay, so when we add these aspects together, we should be okay once things start to resolve. Okay, so it's always helpful to give that context, because any type of fears that one may have with regards to how the Iran conflict could react to one's portfolio, it's not as big as impact as we think. Okay, I think that's the big takeaway to take from this. So as a result, right, when things start to become, once we start to get the data as to what could happen if the Iran conflict may be a little bit more extended than what President Trump originally predicted, 3 to 4 to 6 weeks. Now it might be a little bit longer, right? However, when you add this context in, when it comes to the fact that oil may not be a big player as what we thought originally, it makes sense that things would obviously rebound, right? So when we look at the bottom chart, this is essentially a momentum indicator. So anything below the zero line and going down to the negative portions can be essentially an indicator that things are oversold, right? And it makes sense. Usually when it comes to times where things may have not been predicted by the market, usually markets, investors, and the algorithms would start hitting the sell button, right? Which could lead to a snowball effect of other investors and other traders going with the motion, which would result in potentially being oversold, right? So when we have that aspect of an oversold environment, it leads to an opportunity for stocks to outperform on the upside once people are able to digest the facts, digest the impacts, and kind of see, you know what, it wasn't as bad as we thought. Okay, so I really wanted to just provide some context and proof as to why we believe the markets are starting to rally in response to the news that's coming out. Yes, the ceasefire looked to have ended. Yes, that the U.S. is going to be continuing to monitor the Strait of Hormuz. However, investors at this time, when they look at all the historical context and the future economic information that we're going to share, we are going to see some strength. Okay, and we'll talk about why in just a second. We'll be taking questions at the end, so feel free to jot them down or even put them in the chat. If you're not familiar with the chat function, if you look at where the red button is, where you can hit the leave call, you go scroll over to the right-hand side. There'll be two people standing next to each other, and then there's a little icon where it looks like kind of text box. Feel free to click on it. You can send a message in there so that we can answer any questions at the end. Okay? Awesome. So now we're going to kind of talk into the reason why we believe markets have been a lot more resilient, and we're starting to show specifically on the international side relative to the US, but still we're starting to see some overall resilience in the global market. And it really comes down to the fact when we look at the Purchasing Managers Index. So what that is in English, think of it as essentially a collections of surveys that are sent out to the wider business public on a global standpoint to essentially give a gauge of how they feel the economic environment is from a manufacturing standpoint and from a services standpoint. And essentially, there is a certain calculation based on responses that leads to a number. And anything above 50 is viewed as a strong market environment, and anything below 50 could be a sign of weakness. And what you're seeing on both the manufacturing and the services side is businesses are optimistic, right? And we're seeing a lot of potential growth when we look at the global marketplace. Now, I will say that this is a little bit more skewed to the international side, and we'll explain why in a little bit. But overall, if businesses are feeling optimistic because they're able to get new orders, they're able to see a light at the end of the tunnel, this should translate into more potential returns in the future. Again, nothing is guaranteed, but it's a good indicator. We have seen global exports, right? The goods essentially that are being created and shipped out to other countries have increased on a year-over-year basis, right? If countries are buying more goods on a year-over-year basis, that's a good sign for the global economy, right? And as a result, that's why we're seeing some resilience. Now, I will add that a lot of this is benefiting the international side, mainly because of the fact that the US has experienced a lot of the growth, I don't want to say prematurely, but earlier than the international side, because there's been just a difference in policy with regards to COVID and just the impact that policy has done to the average consumer who is not within the US. The US has always been, even during COVID, spending influenced, while our European and non-US counterparts are not as spending trigger happy as we are. So now we're starting to see a lot more comfort as well as an inkling to want to spend, which has that spending post-COVID has propelled US. That is now starting to catch up on the international side, right? So anytime where there is increase of earnings being generated by companies or just more optimistic data that was not previously predicted by analysts, right, we'll see higher strength. And that was kind of the story in 2025 with international markets outperforming the US. We're seeing a similar trend now as that international consumer and the non-US or international businesses are capitalizing that on their end as well, right? So we just wanted to give some context. So overall, businesses are looking good on the US and global over on a global standpoint. But again, keep in mind, this is being skewed to the upside with international relative to the US. Here we have a little bit more of a chart showing how any increases of global trade over the year-over-year basis on the green statted line, as well as the future or forward potential growth, specifically on the non-US side. So we want to essentially separate it out, right? The blue line is including non-US, green line is including US, because it's the global aspect of it. But no matter if we're looking at excluding the US or including the US, we're seeing an upward trend, which is why we believe we've seen some recent resilience overall. Now, we are also seeing some further support on the international side, right? As you can see, kind of cementing what we talked about earlier with the US and exiting a more favorable environment for its investments in the stock market, is that you see on the green line, it went above zero a lot sooner than international, which is that dark blue line, right? So just last year, maybe even into this year, we're seeing though that global trade start to impact the international side a little bit, I would say, or it's starting to now catch up to what the US has experienced up to this moment in time. Okay, so just giving some further backup to kind of help cement the idea as to why we're seeing a lot more outperformance from the international standpoint relative to the US. Now, going back to the US story, one of the things that we always like to look at is how is the US consumer spending from a week to week or on a more normal basis. So one aspect that a lot of people like to focus on is the weekly retail sales. Why a lot of economists like to look at retail sales is that when we look at the calculation of the GDP, or the gross domestic product of the US, approximately 1/3 is goods, which is what retail sales is, and approximately 2/3 is essentially going to be related to services. It can be a little bit difficult to gather inputs on how much US consumers can spend on services, right? Because there's a large plethora of what a service can entail, right? It can be insurance, it can be healthcare, right? So it gets a little bit harder to measure. So a lot of economists utilize the retail sales, right, which is good oriented, right? We can go and get reports from Target or Walmart or Home Goods or Home Depot to see where are Americans spending money. So in theory, how economists use this is that if retail sales is remaining resilient, then maybe there's a good chance that that type of spending is happening on the services side. That's kind of like how it's viewed, okay? So what we're seeing, that has there been moments of volatility in how consumers have spent? Yes, but overall it's within trend, right? So it's within normal average levels that we would argue, right? So if you're looking at 2020, that's COVID, where there was a big spike, a big drop. That's what that trough is. And then obviously as COVID policies restricted and people were like, I want to spend money again, right? We see that huge plateau about a year or two later. And then obviously as consumers got that urge out of them, right, there was that drop. And then obviously now as people started to wanting to spend again, it's being a little bit more consistent, okay? So overall, as long as consumers continuing to spend, which it does look like it is happening when we're looking on a weekly basis, or when we're looking at what 2023 to 2026, it looks like it's staying within normal levels, right? Where we can start to be a little bit more concerned is if we start seeing a lot more spending declining or staying in starting to be in a more negative standpoint. Okay, so as long as consumers continue to spend, right, that usually means that businesses will be able to translate that into earnings if they're managing their capital appropriately. Okay, so the takeaway from this, consumers are continuing to spend. Now, the labor market has been a very touchy subject over the past few months and going into the end of last year. There's been a lot of revisions, right? And we can kind of see that. The big spikes that you see on the left-hand side is, right, post-COVID, a lot of companies were hiring like mad. We like to use the U.S. non-farm payrolls as an example from the U.S. Bureau of Labor Statistics, mainly because it includes private and public jobs. Obviously, post-COVID, people started rehiring because things were opening up, so we hate to see those spikes. But as the environment became quote-unquote more normal, we started to see a gradual decline. Okay, what that black line is essentially going to be is, what is the break even for us to start seeing potentially a deterioration of the labor market? So obviously that break even fluctuates as specific aspects of the U.S. economy and labor market change. So as you can see, there has been an eventual slowdown of jobs being created. I wouldn't argue. One could say maybe this is a sign of weakness. I would just say this is more of a return to reality, since we've been living for a long period of time in a post-COVID world. And now all those companies that may be overhired are now starting to slow down, right? There has also been a much more strict policy with regards to immigration. Believe it or not, companies during times of lacquer immigration policies were more inclined to go elsewhere to go and hire the employees they need if they couldn't find it in the US. And as a result, with more stricter immigration policies, right, if they can't find the candidates, they would rather just not hire, right? So we're starting to see much less jobs being created. However, it's really important to remember that as long as, again, it's hard to scale, but I'll ask you guys to trust me on this. But when we're looking at January of 2026, really the break even for jobs needs to be between like 50 to 75,000. As long as the number of jobs created stay above that or are around that mean, that average, it's still considered healthy. So yes, there's been a slowdown from the previous pack, but we would rather argue that it's not an indication of weakness, but more as a return to reality is a good way to put it. And I think we can see that with the unemployment rate. Yes, we've seen spikes of that. And it is not something that has something we want to downplay in any point, but it's still within normal average levels, right? If we started seeing unemployment going near that COVID level, or even the Great Recession in 2008, where it was close to 10, right? That's where we'd start seeing oh goodness, there might be some pain in the market. But as of right now, we are seeing within normal averages for unemployment. Yes, that it is important to realize there has been a decrease in the participation rate, right? So if people are not looking for jobs, right, those numbers will stay low. But overall, even with a margin of error, it's still within reasonable levels that we're comfortable with. Okay, so the labor market is at this moment in time remaining resilient, which has also kind of shown a lot of the aspects as to why markets are kind of rallying in response to a lot more positive news and with regards to the Iran conflict, as well as essentially investors banking that there may be some sort of resolution coming sooner rather than later. Okay. Now keep in mind the reason why they're also doing that is we are going into a Congress and House election year. It is not in President Trump's interest to have gas and oil and all that at high levels, because it may not really pull well for him. Because if the House and the Senate were to turn Democrat, it will be very hard for him to pass legislation. So it is in his best interest to try and find some sort of resolution. I know that's not exactly tied into this, but it is something to think about as investors try to parse through the information that's being released on Iran. But we're strictly looking at this from a data perspective, but that's another point to kind of think about and chew on. The only thing that we would say is a concern for us is really the fact that the Federal Reserve and the U.S. government, we believe they're just being overly complacent when it comes to inflation. We believe that their thesis of inflation coming down to 2% is a foolish one, mainly because of the fact that there are other aspects of our economy that have just not shown signs of decreasing, right? We have high increasing housing costs, the increasing cost of insurance, more recently oil and food costs, etc. But we are more inclined that inflation is here to stay, and it's probably going to stay above that 3% level. Now, you and I both know there are other aspects of inflation that are higher than 3%, but when we have to go off of the numbers that is being reported by the Federal Reserve, which is that personal consumption expenditure index, because that is their preferred measure of inflation. Yes, we also don't live in a core world. Core is when they extract food, volatile, quote unquote, food and energy costs. But even when you extract the volatile food and energy and when you include it from an overall basis, all the signs are showing that it's not going anywhere near 2%. And we are more inclined that it will hover around the 3% or maybe even higher. Okay. So one of the things that is going to be potentially helpful during this time. A lot of people consider inflation protected bonds. Some like to maybe invest a little bit more aggressively in the stock market, since equities have shown to combat inflation over time. But it's just one of those points that it's important to really highlight that inflation is here to stay. And we believe it's a little bit foolish to think that it's not. Okay. So I kind of want to end with a quote before we go into the summary, because I think it really, really is important to just kind of see when it comes to our approach, when it comes to analyzing markets and potentially making recommendations. John Maynard Keynes, who was a Nobel Prize economist back in the day, I think this quote, I know many of us have probably heard me use it ad nauseum, but when the facts change, that's when I'm going to change my mind, is what John Maynard Keynes, and I think this is exactly right in this environment as well. Yes, there's going to be noise, but when we look under the hood, we see that the data is a lot more optimistic than one would think. Okay. So if we were going to summarize today's presentation, we can summarize it into three attributes or 3 points. One, oil is not as impactful as it once was in history. So as a result, oil shocks in oil prices may be short-term painful, but overall, the economy should remain resilient as long as the conflict remains shorter than anticipated. Okay. So if we start seeing prolonged prices above that $200 level going into a year or longer, that's when we may start seeing some weakness. From a global standpoint, when we look at the Purchasing Managers Index, when we look at exports, we're seeing strength overall. However, it's important to realize that it is skewed to the international side. And lastly, the main point is that inflation is here to stay. We don't believe it's going to be going down to that 2% level. It is prudent, if that's something that is an aspect you would like to potentially protect against. There are specific investments like inflation protected bonds or even other types of securities that can help offset that. Okay. So those are the three. There's obviously a lot more points that we could cover, but we wanted to try and get through as many of the most important details that I believe that kind of sum up the first quarter of 2026, and then leave it up to you guys with regards to any specific questions that you would like to ask that from what you've heard, or you just want our thoughts on. I'm happy to open it up to questions at this time. If you feel more comfortable putting it in the chat, feel free to use the chat function, or if you would like, you can also, we'll start the ability for most of us to unmute in order to ask those questions. So I will open it up for questions at this time. Questions do we have?
And while we do get questions here, Karmi, I just want to plug in our next couple of webinars coming up. So I'm going to drop them in the chat box here. First one is Trustee or Full-Time Job, Decoding the Workload. That's on the 24th at noon. That one's with Francisco. And then how to document your specific healthcare wishes for your agent on the 13th of May at noon. That one's going to be with Michelle Dexter. So those are a couple registration links. We're also going to be sending out email invites as always. So we'll keep you posted. Yeah, back to you, Karmi.
Yeah, thanks, Alexis. Great question. So one of the questions that came up was, we realized that 20% of oil flows through the strait. How much other goods also flow through the strait? So that's a good question. The main point that is where a lot of the concern is coming from really just primarily revolves around the Strait of Hormuz controlling 20% of the oil flow. So it is a central point of trade from the Middle East, as well as through other points in Europe and such. But again, at this time, remember, we want to view it from a glass half full. Yes, it's 20% of oil flows, but that still means 80% of oil is being accounted for through normal trade aspects of it. So what we're hoping, and which is why I think the market was rallying today, is with President Trump recently announcing that they're going to be essentially only limiting Iran vessels from going through the Strait of Hormuz, is my understanding, and giving a little bit more leeway to non-Iranian ships. We should see hopefully some relief soon from oil prices, but the concern from the market is specifically tied to oil. Yes, there might be other trade that's going through there, but it really has to be with regards to the impact on the oil market, because it is about a fifth, right? No, it's exactly a fifth of global oil outflow, right? So that's a large percentage, right? Now, if we were looking at from a glass half full standpoint, we still have 80% that's accounted for. So we'll see what exactly President Trump means when it comes to no ships going through the Strait of Hormuz. And my understanding, reading through the prints, is that it really is a response to Iranian vessels and potentially some of their allies, just to kind of put a further chokehold on Iran to play ball. But it sounds like there's also going to be some work from the U.S. Navy trying to clean up the mines in tandem while this is happening. So TBD, really, but the main impact that investors in the market is concerned about is oil. No, that's not exactly the answer you were looking for, but that's the main concern, is what the impact is going to be on oil. But it looks like there's going to be some sort of resolution with that, which is why we saw the market rally today. But overall, good question. But ultimately, it's TBD. We'll see what that means. Hopefully sooner rather than later. What other questions can we answer at this time? Okay. Either I did a really good job or we went way too fast. Overall, I'm always open to questions. Feel free to shoot me an email. My email is there on the bottom. Go ahead.
Karmi?
Yeah.
Karmi, is there anything that you've heard on using the strategic reserves that we have, all the oil that we've got backed up, to try and lower the prices for the people?
Yeah,
gas pumps?
It's a good question. So recently there have been reports, confirmed reports, that the administration has utilized strategic reserves to try to lower the gas prices. Now, keep in mind, though, there's a certain amount that's being released per day. So it's not really giving a big of impact that many have hoped for, mainly because of the fact of how much the Strait of Hormuz impacts oil prices. Okay, so yes, there's been confirmed reports of oil reserve of the strategic reserve being utilized, but it's just not strong enough to offset the risk from a market perspective from the Strait of Hormuz. But a good question. As a result, we may see some sustained oil prices in the elevated levels. I know I faint when I see Costco at 487 and Circle K at 499 a gallon, right? But we're hoping that this is short term because it is going to impact a lot of consumers going into the summer season if this continues. So to answer your question, yes, confirmed reports of the strategic reserve being utilized to try and lower prices. It's just not enough to offset the deficit because of the Strait of Hormuz being up in the air.
Thank you.
Great question. So another question came in. What is causing the restrictions of supply of building materials and workers in the construction industry? That's a really, really good question. And there's going to be, in my opinion, a couple areas that have been impacting that. Really, a lot of it is going to be with regards to, believe it or not, there is a large amount of other materials that are going through that have to pass through the Strait of Hormuz, right? That is one aspect. If we have certain materials that need to come through there that are no longer able to, it can cause delays through construction and such. There's also been a lot of, believe it or not, a lot of builders have been finding not as much opportunity to potentially build new areas and such or build new homes just because of an oversupply of that. It was funny, my wife was talking to me recently, as of yesterday, in our neighborhood in Central Phoenix. I think we've seen a lot more for sale signs than we ever did. Why is that important? Is the fact that if there's now starting to be a overall supply of homes and other buildings and such being open for sale, what's the incentive for other construction or even home builders to want to build more homes if there's already going to be an oversupply? So it's really going to come down to just a supply and demand issue, as well as then adding on other external aspects with trade disruption. That's the best answer I can give you right now, from what I have seen. But overall, a really, really good question. What other questions can I answer? I'll give it another minute, and then if not, we'll close out the presentation. So last call for questions. All right, everyone. So if any past questions pop up later, feel free to shoot us an email at the email address below. Feel free to give us a phone call at the number shown there. Happy to answer any questions that come up. Overall, like I said, there were a lot of things we could have covered today. The goal was to try and pick the most material ones, in my opinion. Oh, I think we have one hand raised. Go for it.
I just wanted to say thank you for my birthday wishes.
No, my pleasure. Hopefully you're able to have a great
This
birthday.
is Patricia.
Hey, Patricia. Hope you had an amazing birthday. Hope you're feeling good.
I had a fabulous birthday. Thank you so much.
You bet.
We'll see you later.
We will see you later.
Bye-bye.
Hope everyone was able to enjoy the presentation. Have a great week ahead. And like I said, this will be posted later. for those who want to peruse it later on our YouTube site. So thank you all, everyone, for joining, and have a great week ahead.